this is the decade for India. But just like every other success story, this one will also have its own set of hiccups. What are some of the obstacles that will come on the way of India's growth story? And how can investors navigate them? Well, despite India's attractive demographics, stable government, and so many reforms, even strong businesses have faced setbacks lately. In the recent years, this has resulted in the fall of prices of many growth businesses like Asian Paints, Avenue Supermart, TCS, Infosys, Relaxo Footwears, Bajaj Finance, Dixon Technologies, Divis Labs, and so on. While India's growth story is brewing, there are still many potholes, recent one being the Hindenburg report against Adani. Also, the world is moving to quantitative tightening, and RBI is also raising interest rates. Then next year is an election year. Given such a scenario, the real question is, will future equity market returns beat past returns in this golden decade? To answer these, let's welcome the panelists of our next session who will discuss on, will future equity returns beat past equity returns, and which businesses will be leaders of the next bull run? Let's meet our panelists now. Our first panelist is Mr. Rajesh Kothari, who is the founder and managing director of Alpha Accurate Advisors. He is the visionary behind the customer-driven and excellence-based approach. A CWA and an MBA by qualification, he has a rich experience of more than 20 years in the Indian capital markets and has handled several investment projects in premier investment institutions. During his tenure as a fund manager at DSP Merrill Lynch Fund Managers, the equity assets under his management flourished from $100 million to $1.5 billion. All through this period of 5 years, the equity schemes often ranked in its first quartile ranking by CRISIL. Our next panelist is Mr. Andrew Holland, the CEO of Avendus Capital Public Markets Alternate Strategies, LLP. Prior to joining Avendus, Andrew was the CEO of Ambit Investment Advisors, where he built one of India's largest and most successful hedge funds. He was also the managing director, Strategic Investment Group for Merrill Lynch in India. Andrew was the chief administrative officer and head of research at Merrill Lynch in India. He successfully built DSP Merrill Lynch to a rated research broking house in Asia Money, Institutional Investor, and Greenwich. He also worked with County NatWest, Barclays, and Credit Suisse. And our last panelist is Mr. Jyoti Vardhan Jaipuria, the founder and MD of Valentis Advisors. He has an overall 36 years of experience in the Indian capital market, including 21 years at DSP Merrill Lynch and 8 years at ICICI. He was head of research and strategist for India at DSP Merrill Lynch. He helped build the research team as the leading research provider in India, as well as one of the top institutional brokers in the country. As a strategist and analyst, Jyoti was rated amongst the top in India by leading institutional investors and figures in the top 5 leading vote getters regularly. This session will be moderated by Mr. Amit Jeswani, who is the founder of Stallion Asset. He is a double charter and has successfully completed his Chartered Financial Analyst and Chartered Market Technician. He graduated in business with finance from Kingston University, London. He has been investing in capital markets from the last 14 years and is an active member with the Association of Technical Market Analysts and Indian Association of Investment Professionals. Over to you, Mr. Jeswani.
Thank you so much, Akruti. Good afternoon, everyone, and thank you for joining us on this important discussion of will equity returns of the next decade be equivalent or better than this than the last few decades, or we'll have a mediocre equity season in this decade. The second question is, who's going to lead who will be the leaders of this bull market. Since 1986, 2nd January 1986, Sensex started. And since 1986 till date, Sensex has given a 13.5% CAGR. The first decade from 1986 to 1996, Sensex did 18% CAGR. The next decade from 1996 to 2006, Sensex gave a 12% CAGR. From 2006 to 2016, Sensex did a 11% CAGR. And from 2016 to now, our CAGRs are closer to 12%. So first question, Andrew, I'll start with you. What do you think the next decade? Do you think the markets can do 13% or better? Andrew.
Sorry about that. Thanks, Amit, and thank you, PMS AIF World, for the opportunity. And I mean, you probably worked out it's some of the panelists here are all ex-DSP, so hopefully we won't all speak the same in terms of our views. Listen, I think 12-13% is not a bad kind of growth rate for most for our markets. Given that, if I take the last 3 or 4 years at least, we've had very little kind of earnings growth, coming from corporate India. So when I look ahead, I'm just thinking, very simply, if we're talking about a $5 trillion market cap, a $5 trillion economy, and typically, at some point, this market cap of India will be 100% of that. You can see where the growth is going to come from in terms of the returns. So it's not so difficult to work the kind of returns for that. But obviously, there's going to be dispersion within that, and that's what all India's always been about: is finding those sectors and companies, which are going to be the leaders of the future, and that's where you're going to get the growth. So whilst the headline kind of Nifty or Sensex, whichever you want to use, might show you only 12 to 13%. You're going to get significant returns from other sectors, which will give you a lot higher, 20 to 30 to 50% over that time period. So it's really about where you choose to put your money, rather than saying it's just about the index.
Makes sense. So Rajesh ji, what index, what sectors would you say would be leading this? So Andrew, I completely agree. I believe everyone here agrees to what Andrew ji said, that it's going to be sector specific, stock specific. You have your benchmark, which will do 12% odd CAGR, but of course you'll have multiple stocks and sectors, which will do way better than the benchmark. So Rajesh ji, I'll come to you. Which sectors, or if you can speak stocks, that would be great. You follow a AAA philosophy. Which sectors would you believe would do well this decade, and why?
Hey Amit, hi. Thank you first of all, PMS AIF, for providing this wonderful opportunity. It is always my pleasure to interact with you all members. Amit, before we come to sectors, in fact, there's one point which I wanted to highlight. In the opening remark, you mentioned that how the decadal kind of a returns of every decade, correct? So if you look at 1990 to 2000, and then 2000 to 2010, and then take 2010 to 2020, while the returns were 12, 13, 14, 15% in each of these 10 years period, but we need to keep one thing in mind, compare it with the interest rates. So for example, in 1990 to 2000, if suppose Sensex delivered 16% compounding return, actually, it was not great, because interest rate during that time was 15% or 17% or actually 20%. So real rate of returns were not that high, or might be even zero. And then you compare with 2000 or 2010, again, market delivered about a 14% kind of thing. And then interest rates were probably about 10, 11%. So first time the real returns were about plus 3%. And then you compare last decade again, then interest rate again came down and real rate of return again improved further. So I think what is very important is not just the absolute rate of returns, but compare it with the interest rates in the prevailing in the country. And when you look at it from that perspective, I think this 10 years period, the next 10 years, the crystal gazing, and we all are trying to do that. And let's assume roughly GDP at around 5.5 to 6.5. and you add 3 to 4% inflation, you get about 9 to 10 to 11%. But then if you compare the economy, which is divided in two parts, the organized economy and unorganized economy, and since India still has huge unorganized sectors, and therefore the Sensex or Nifty or equity market can deliver 100, 200 bips, higher than the, the nominal GDP growth. And then, of course, the sector perspective, again, while we are all trying to talk about different sectors, it is not going to be uniform across 10 years. It is not that there is only one or two sectors which will do well throughout 10 years. No, it will not be. The few sectors might do well in the early cycle of economy, and then few sectors will do well in the mid cycle of the economy, and then the few sectors will do well at the late cycle of economy. So there is nothing called one sector for 10 years. Currently, what we are positive, for example, of course, we are hugely overweight on capital goods as a one sector, banking and finance is second sector, automobile and auto ancillary as a third sector, and consumer as a fourth sector. These are the four sectors right now where we are bullish on. But that doesn't mean, please don't take it as my 10 years view, because cycles keep changing fast, and you need to make sure that the valuations and the growth of different sectors at the different cycles of economy, that basically decides your right allocation to the sectors. And that's what makes the investor a little bit more alpha, ultimate winner in this equity market.
Makes sense, Rajesh ji. The learning is being nimble is important. You take 2-3 year views and keep every 1-2 years, you keep taking the next 3 year views. So that's a great learning from Rajesh ji. Jyoti ji, coming to you. Where are you? What are sectors that you are bullish for a 3-year period? Or should we start by 3 years and not directly by the 10-year view?
Yeah, probably makes sense. So, like our view has been like a very simple view since last year. Buy domestic sectors, avoid global sectors, because, that's the growth is in India, the global economy is going to struggle. And so relatively, India will be the fastest growing economy over the next 4-5 years, at least amongst the top 20-30, I'm sure. There'll be somebody in Africa which grows faster. And so you play where the growth is, play the growth. So for us also, banking has been one. I think it's been a very consensus, universal sector. The sector's done very well. So I don't think we'll get a similar sort of return which we got last year, because last year it was coming off a very low base. But even over the next few years, you'll have, credit costs being low, NPLs being low. Second is you'll have credit being strong because the economy will pick up. So it's still a sector which will give returns. The other thing we've been looking at and we've been very positive on is capital goods. And I think that's a sector which continues to do very well. So here, I'll just step back and think of what the government thinks. So if you look at the government, this was the last budget before the elections. And so generally you would think, okay, this is going to be a very populist budget and you'll have a lot of freebies thrown all over the place. Ultimately, they've cut down the subsidy by 0.6% of GDP. So all the fiscal deficit reduction has come entirely because of subsidy. They increased the capex by 37% in the budget. And, even if you add the PSUs, it's still a whopping 24% increase. If you look at the last few years, capex to GDP ratio has gone up from like 1.6% or something to 3.3%. So, effectively, we have doubled capex to GDP. So, there's a strong thrust from the government which is coming on capital expenditure. So far, we've seen very faint signs of the private sector coming through. But I guess, once the momentum starts building up, the economy starts to pick up, private sector will come back, because just remember, today we are running debt equity levels at corporate India, which is historically at low levels. So, we'll start to see that thing picking up. So I think, it's going to a big capex driven growth. And, that's the way cycles play out actually, right? If you want, we can just go back into history. 97 to 2000 was all about tech. Worst sector, capital good, the best sector was IT. 2000 to 2008, best sector, capital good, worst sector, IT. 2008 to 20, capital good again became the worst sector. IT and, FMCG did well. So I think, typically after every fall, you have a new sector leader. And so these high quality companies, great companies, high ROE, low debt, but then very, very high valuation, where we ended up with this buy at any price. That probably is where, the struggle will be for this cycle.
Makes sense. Makes sense. Jyoti, just one counter question.
Yeah.
Alan Greenspan would say that he used to follow this index called the underwear index.
Yeah.
Since you're invested largely in domestic facing businesses.
Yeah.
If you look at numbers, Rupa delivered minus 45% growth, a decline of 45%.
Yeah.
Lux reported a minus 30% odd decline in numbers. Just giving you an example.
Yeah.
On the other side, Page also didn't do so well. On the other side, while we speak that, buy at any price is not a right strategy, of course, but stocks like Siemens in the capital goods space, they're at 88p. Stocks like ABB in the manufacturing space, they're at 80p plus. Then all your bearing companies are at 50p. So be it Schaeffler, be it any other Timken at 62 times. So they are not cheap either.
Yeah.
How do you play the manufacturing plus the domestic economy this quarter looks like it's slowing down somewhat, ex-banking. Banking, there is a NIM expansion. So how would you play out this whole domestic theme? Because from one valuation risk, we're moving to another valuation risk.
Yeah, so definitely. So, there are two things to this. So one is like the whole consumer is effectively being slowing down relatively. And that's a trend we are seeing across. In fact, the rural slowdown is even more marked than the urban slowdown, I would think. Because, like if you go back 5 years ago, we had NREGA whose, allocations were going up on a constant basis. People were selling their land in rural areas. And so there was 3-4 drivers which were like just leading to a constant increase in rural income. That has stalled. And, that's why I said in the last 5 years, there's been a pronounced shift by the government more towards, capex rather than consumer. And that's where, you can see a lot of the demand numbers come. The other question which you raised very rightly is, are these already priced in? What's priced into the market already? And, some of this is priced in. It was like, a non-consensus 18 months ago, but now, banking is, anybody you talk to, banking is my top sector and capital good is my top sector. The only thing you have to remember is what you have to look for companies, and quite often at a low end of the earnings cycle, valuations will sound large. So it is like, can I see visible earnings growth, which is going to, 3x this earnings growth over from where we are today to 5 years later? Like if we go back into the earlier cycle of, capital goods, 2003 to 8, most companies ended up expanding their earnings by like 5x or 7x. So that's the initial stage. The valuations always look high because people are now building in a much higher growth. But there'll be some companies here which probably are no longer looking good to hunt for. It's getting more tough as you get into the cycle. It always gets more tough to hunt for companies.
Makes sense, Jyotiji. Andrew, where are you placed, both on the long side and short side? I can't hear you. Sorry, you're on mute.
So let me talk about some of the themes, which are the longer term themes, which will always be on the long side of the portfolio. And the great thing about running a hedge fund, actually, is I don't need to fall in love with any sector or stock, but that aside, there's 3 big themes to my mind. One is a global theme which will play out in India, and that's going to be defense spending and renewable spending. That's going to happen globally, and that's going to be what picks up the global economy going forward. And then in India, it's a very simple story, right? In that you have, 420 million Gen Z and millennials. Same in China, actually a little larger. China's about 400 million. So, we know where consumer spending is going to be, and the world knows where the consumer spending is going to be. And obviously, China's been one of those places where everyone's going to, trodden a beaten path to. And I think India is the next. So I know that consumer is going to be a big, big play as a theme over the next decade. So that's not going to go away from us, whichever way I look at it. So, you can play that many different ways, right? From autos to, through Nika to Paytm. You can play many different ways of how to get that, the trend and theme playing out. And then, the other theme is obviously the security theme, where, companies and governments are going to have to, secure supply going forward. And that's going to lead to And that's where, when people have been talking about the capital expenditure by the government, that's the usual roads, bridges, and XYZ. That's the L&Ts and DHLs of this world. But companies coming in, smart manufacturing, smart cities, smart whatever, is the ABBs and Siemens of this world. So that's what's going to differentiate, I think, in this CapEx cycle going forward. I think the final theme, which is again is going to be big, is domestic tourism. I think the whole of the, we've all spent quite a lot of time exploring India rather than going outside of India, and it's actually not so bad, right? And I think the tourism sector and services sector around it is going to be significant. And the final theme, I think, is electronics. I know everyone just talks only about mobiles, but if we can get the domestic electronics industry growing and then start shipping that offshore in terms of exports, it's going to be huge. It's going to be absolutely huge. That's a big theme. Now on the short side, which you asked me about, it was hinted about, right, in terms of that, you're going to have certain sectors that do well, maybe the first year, and then they obviously, have whatever problems they might have. And that's going to be a feature of the market. So when you talk about the index, say, going up 12, 13%, within that, you're going to have those sectors and companies which do very badly, for whatever reasons. And that's where we'll keep our shorts. But I don't have any kind of negative sectors at the moment. It depends on your global view to take that view at the moment. So if you think interest rates are going down, are they going to go and hold the Fed, for example, because there's a recession coming, then obviously commodities would not be part of your long basket in my mind.
Got it. So ex commodities, you're basically bullish on everything. Andrew, you spoke about consumer tech, like stocks like Nike and Paytm. Do you believe that there's a J curve which is finally coming? The losses have come down, the valuations have come down, and the growth remains strong in some of them, at least in the fintech ones like Paytm and.
So I think with Paytm, I think when it got listed, maybe there was just how it was projected to the marketplace in terms of there was many different revenue streams that people were looking at, which would either could have nascent for them, or they would think about other competitors. I think what the company's done is work that out very quickly and focused on the areas which are growing for them. I mean, it's great. You can use your customer base and get 4% return on a loan, which you don't have to put down yourself. A bank's paying, taking that risk. Not a bad business, right? So I think the market's starting to understand it and starting to now look at the real kind of core business rather than, whether they're going to make money from gaming or, other kind of smaller parts of the business. And I think that's the opportunity. And I think that's what we're going to see is going to be more tech-enabled financial services or consumer-facing services, which are going to, continue to kind of take a lead in our normal kind of shopping. And if you're looking in the US now, you go to a shopping mall, it's more about experience rather than you going there to shop. And I think that's how we're going to change here as well.
Rajesh, do you share the same views for consumer tech? You've been invested in any consumer tech names?
I think, for us, what matters most is, keep checking the milestones of company, whether it's consumer, whether it's a tech, whether it is a fintech. What is important is keep checking where are we in terms of the earnings growth cycle and what kind of evaluations are already factored in. Like, for example, you mentioned that, in your previous remark that, there are many capital goods companies that are available, let's say about 80p or 70p. Undoubtedly, they will be trading at 70p or 65p because we need to understand, like companies, what we have mentioned, like, the global multinational companies which are listed in India, they have robotics as an advantage. They have automation as an advantage. They have a global product portfolio available for Indian country. There are no Indian companies probably which can even bid for such contracts. Whether it is a specialization on the railway, whether it is a smart grid for power transmission and distribution, whether it is a data center 3-layer power security, there are no Indian companies who have a technology. So we should not fall into the value trap. These value traps are always most dangerous. Because normally what we have seen, for example, capital goods sector. So during the bull time, the capital goods index went up 20 times. Sensex went up 5 times. Capital goods index went up 20 times. Today, the capital goods index is up about, say, 2.2 times. But what is most important, what common mistake a retail investor, a common investor makes is that they avoid 60 PE stocks. And you buy 6 PE stocks because you think 6 PE is cheap. But then you come to know that 6 PE is actually 100 PE because the profit never comes, or the receivable becomes working capital problem, or the company becomes a heavy debt company, and ultimately company goes for NCLT or NPA for the banks. So very, very important. What you are buying for is very important. अभी आप ताजमहल में चाय पीने को जाएंगे और अगर आप कोई लोकल रोड पे चाय पीने को जाएंगे, दोनों डिफरेंस है, दोनों वैल्यू फॉर मनी है. It's not that only roadside tea is a value for money. Even that is value for money because during that time you require peace of mind and you require productivity for that 1 hour team meeting. Am I right? So what is most important is please remember what you are buying into. The technology as a moat, if it is an MNC company, will always trade at 60p. You will not get that company at a 10p. Even during the worst times, they will always trade at 50p plus. So there's one point I wanted to make. Second point I wanted to make is that the consumer company, let me give one example. One of our investors also asked that, how we actually see the big becoming bigger, because we believe that big is going to become bigger. Now, let me give one example, and please put a disclaimer because company I may talk about and which we might be holding in our portfolio. For example, Trend. Now, Trend is a Westside, is a format which everybody knows. 4 years back, Westside was 1.75 million square feet. Biggest company in India on the retail apparel side. But today, there is Zudio, which is 1.75 million square feet. So, Trend is added another trend in the company, just in a matter of 4 years. And that's huge. So it is nothing like that, big cannot become bigger or growth can become saturated for a large company. There is nothing like that. It's all required from the company strategy. The management is to have a right strategy to penetrate the market, right to win the market share, have the right execution on ground, and make sure earnings compound by 18, 20, 25%. Like SRF, one of the specialty chemicals which we hold for a long time. The specialty chemical revenue was only 700, 800 crores 6 years back. And it becomes 6 times in last 5-7 years. 6 times. Economy is growing at 8% per year, 10% per year. And company, one segment has become so large that it has become another SRF in making. Correct? And that's the beauty about the companies. When you identify such sectors, when you identify such companies, that's how what we look at it. And we don't look at whether it's a domestic theme or global theme. What's important is that is the company relevant for the global customer or not? And that's important. So today although global world is entering into recession and slow land, the Indian companies are actually benefiting, although they matter the global front. For example, capital goods. They are benefiting from Europe plus one opportunity. Many of the companies in bearings, they have announced 1,000, 2,000, 3,000 crores of capital expenditure to shift the line from Germany to India. Now, Germany will grow at 0%, but few companies which you mentioned, they are high PE, they are probably growing at 30%. They are not going to depend on India. They are actually going to become hot global parent companies. So, we don't want to have any bias. When we create a portfolio, no bias ki boss global lena hi nahi hai. Nothing like that. If your company is rightly positioned to cater to the world growth, to win the market share from the globally competitive players, at the right cost competence, that's very important, has a benefit of China plus one, has benefit of Europe plus one, and of course, has benefit of core competence in Indian country, that's where the growth will be significantly better than the nifty earnings growth. And that's what job of our fund manager is, to keep delivering better returns than the benchmark. And how do you get it? You can get it only when you invest in the companies which have a right balance sheet with right capital allocation, has a potential to grow significantly better than the Nifty or BSE 500. And that's what we keep doing.
Makes sense. So you say focus on the business model. If the business is okay, you're okay to pay up a higher valuation as long as the business...
Not higher valuation, reasonable valuation. Right. 1 spoon of Ariel and 5 spoons of Nirma washing powder, which is cheap, I don't know. At times, I think Ariel 1 spoon is cheaper than 5 spoons of Nirma. Actually, you work it out, the cost per bucket of washing machine powder, actually, to wash 1 bucket of clothes, Ariel is actually might be cheaper than even Nirma. Perception is that Ariel is expensive. So you need to make sure that what you are paying for, what business model you are paying for. And accordingly, you need to decide the valuation. Valuation has to be always reasonable. You cannot overpay. But what reasonable is? That 30p makes it expensive. Whether just make it 5p makes it cheaper. I don't think so. There's a huge difference. There are so many, yesterday I was talking with a few of my retail investors, and they were saying, why don't we look at company A, B, C, D? All our capital goods companies trading at about 15, 17 times with a checkered history, with a past track record of becoming NPA, but next 2 years, they are promising to the world that they will probably grow 2 times profit growth. Definitely, we will not touch those companies. They might be look cheap, but it's a deception. That's the illusion. And actually, ultimately, again, investor will lose their money out of that. So you need to be very, very careful, filter it out, and then take the view.
So Rajesh ji, so for everyone, Rajesh ji is saying being the good quality ones, companies like Trent, like this quarter was probably the worst quarter for consumer companies. In this quarter also, Trent grew earnings, like revenues were growing at 61%. It's a hyperscaler. So if you between a 42,000 crore market cap Nykaa and a 42,000 crore market cap Trent, probably Nykaa will grow at 35%. Rajesh ji is choosing a 61% grower who's pivoted from the West Side stores to now Zudio, and you have Tata, of course. So business scalability is a very important part in Rajesh ji's investing philosophy, and that is where he believes larger pie of alphas will get created. Jyoti ji, like SRF also, the second example, has been hyperscaling, reinvesting 100% of capital at very high ROICs. Every quarter, they announce a new capex. So I've not seen a quarter where SRF has not announced a new capex. So Jyoti ji, are there companies which are the hyperscalers in your part and you believe will lead the next bull market?
Yeah, so, like I said, capital good is one. So let me give you another angle or another theme. So one theme which we are playing is really, there are a lot of companies which are commodity users, which last year saw massive margin erosion because commodity prices had gone up. So now, a lot of these companies are probably going to do well over the next few years because the margins will start normalizing as commodity prices come down. Secondly, because there was a jump in commodity prices, they managed to see an increase coming in the end product prices. So
sorry, can you give 1-2 examples with full disclaimer? Because, just for everyone to relate to what you're saying.
Yeah, so, without going company names, what I'll do, so one example is the ceramic sector, the tile sector. So basically, they were hit by a massive gas price increase, and, gas prices are starting to come off. They had great sales growth last year, but they had awful profit growth, awful EBITDA growth because of margins just compressed. So now what will happen is going forward into this year, you're going to start seeing margins start to go up. So even with sales growth not being as strong as they were last year, even if with all the interest rate hike and some slowdown in the economy, we see demand start to slow down a bit. They're going to see raw material prices come down, raw material to sales ratio will come down. You'll have margins starting to normalize and a huge earnings growth which will come in. So essentially, they will get benefit just from the fact that your commodity prices which have come down, which was the raw material, and so they will gain from there. So that is one segment of companies. So I'll give you another angle to this. So there's some companies which got hurt a lot because raw material prices were falling and not going up. So for example, the PVC pipe industry, they had a constant fall in PVC prices month after month after month. So that's the raw material. The prices were falling every month. So logically, they should be happy, right? But the fact is every month, they were taking inventory loss month after month after month. That business is, now PVC prices stopped falling from December. PVC prices starting to move up. But just remember, they're going to be much lower than what they were a year ago. So you'll get the benefit of my pipe prices are cheaper than what they were a year ago. So demand will pick up. Second is now they'll no longer have this inventory loss, which they were getting. In fact, on the margin, they probably get an inventory gain. So, these are companies which now, will have growth coming in top line, growth coming in margins. And so, you'll have a massive profit growth coming through, and that will help. And all these stocks have underperformed because they did badly last year. Whether it is ceramics, whether it's PVC, all of these people underperform. So, now they have underperforming stock where margins are picking up, growth is picking up, earnings are picking up. And so, these are sectors you can make money on.
So building materials is the theme where inflation, the cool off of inflation is helping building material names. Just for everyone who's on this conversation, you've had, like how Jyoti ji said, resin prices had moved from 70 to 160, which is the key raw material for PVC pipe makers. And these the resin prices are back to 70 rupees. And now, so last 2 quarters were very tough for these companies. Companies like Prince Pipe reported losses. Astral had very weak growth. The revenue, the volume growth were decent, but of course they had inventory losses. The same with Kajaria. The gas prices had moved up a lot, and now gas prices are, and in fact, Morbi was shut for 1 month. Kajaria was on, but Morbi had taken 1 month shut because they didn't believe that they'll be able to pass on such high prices to customers. And Kajaria also has had a negative volume growth this quarter. So the opportunity stays large in building material names. After COVID, there's been a massive real estate boom, and hopefully real estate building material names should do well. Andrew, what is your thing about inflation? You're avoiding commodities. Your views very strongly because you track macros a lot. I see you tracking the Fed a lot. Do you believe inflation has peaked and time has come to bet against inflation?
I do. I think inflation has peaked, not just in the US, but I think probably in Europe as well, because the gas prices there. I mean, the winter's not been as harsh as everyone's been expecting. So gas prices have fallen. So you'll see inflation coming down in Europe too. But if you actually look at the kind of month-over-month kind of rate of increase in inflation, the last 4 or 5 months, it's actually been negative in the US. So I think that's it's all about whether when he's going to pivot and when he's going to go on hold. And our view is it's going to be either this time around. I think it's going to be this time around. I'm even wondering whether he's going to even do a rate increase. So that will tell me that the global economy is going to get soft, and interest rates are going to come tumbling down in the second half of the year, which is given our RBI governor is really kind of following the Fed. From what I can work out, that bodes well for interest rates falling here. So if I take that kind of scenario, and it's a kind of a first half, second half scenario in terms of that deflation trade will come in, and that means lower interest rates. And the markets in the US are sniffing that out already, aren't they? With the tech stock kind of rally that you've seen. So, that plays into the whole of the banking sector again. That's a great deflation theme. Autos would probably be a good player in that as well. So those are kind of more shorter term kind of plays within a longer term theme of consumption as well. So that's what we're thinking in the very short term. But what could go wrong? I mean, what are the risks as well? Well, remarkably, not just in the US, but in Europe as well, the consumer's holding up, is continued to spend, I could probably make a case now that Europe could actually kind of skirt recession this time around, which begs itself is then have you got inflation and little growth, which is stagflation. So that's what the market will grapple with. But I think the opportunities in the second half of the year for India to attract foreign flows will be significant. I don't think it's going to happen this half, because if everyone and the Fed, let's say the Fed does go on hold very soon, everyone's going to look for growth, emerging markets. We all know this story. Emerging markets is going to be the place to invest, and India will stand out. But our valuations compared to anyone else is still very high. So you have a catch up with maybe China, Korea, Taiwan, all doing well, and with China reopening, that's great for Asia anyway in terms of the exporters into China. I think India is probably going to have to catch up in the second half of flows. We will get flows, but we probably will, disproportionately lower than maybe if our kind of valuations are lower. So maybe in the second half, as earnings upgrades start to happen, as some of the capex cycle that Jyoti kind of alluded to from the government starts to come through as well and has that multiplier effect across the economy, will be where, you know, we'll start to see the earnings upgrades and then more money towards India. So that's how we're thinking over the next 1 year. But the themes that I talked about will play over multi years and at least over the next decade. Consumers not going away, and that's the big opportunity. So, you know, if you're paying 30, 40 or 50 times, just fast forward 5 times and say, well, how big will this company be? What will it be sales and its net profits at that time, and take a view of what you think the PE should be then. And I think you'll find it's probably looking very cheap 5 years down the road if you take some of those, take those as some of the assumptions of consumption. So I'm kind of overall, you know, more bullish on India than I have been for some time. I'm getting a lot more constructive on global, because I do feel the Fed's got it completely wrong, and they will have to reverse very soon.
So Fed has increased rates in 2022, 4 times by 75 bips, 2 times by 50 bips, and 1 time by 25 bips. So that has what 2022 been like. If this reversal happens, then you've seen value stocks doing very, very, very well. Stocks like, it started with PSU banks, railways, etc., defense. The value ITC, the value basket has done well. Coming to you, Rajesh. For 2022, and if interest rate, and this is what Andrew believes, that interest rates come down, which is what he's expecting, growth stocks should make a recovery. Is that the same view, Rajesh, that you share?
Well, I think you know, the interest rates in India has already peaked, correct? So world global interest rate, of course, there is a perception in the market, and in fact, if you look at the Bloomberg, everybody is expecting, while Fed is not saying, but market is already believing that there will be interest rate, peak of interest rate in another 1 or 2 quarters, and then Fed will probably, you know, cut down even on interest rates. But if you look at India, the back home, you know, this is probably the last, you know, interest rate high. And remember one thing, you know, the debate globally is -1 or +1. And debate India is 5.5 or 6.5. I mean, there's a huge difference between what world is currently grappling with and what India is currently talking about. Am I right? So clearly, India is the place to be in. Last 18 months or 16 months, I think October 2021, correct me if I'm wrong, Nifty was 19,000 and today we are at 17,500, something like that. So 10% is a price correction, 16 months of time correction, and 30% earnings growth in that time. So practically, if you look at it in a different way, probably you are getting Nifty cheaper by almost 25 to 30 to 40%, depends how you look at it, right? So I think it is a good time. There are some uncertainties. It's not like everything is green, and you should not buy when everything is green, because you have to pay price for everything. So right now it is like, you know, yellow amber zone. There are some confusion, some uncertainties, some global slowdown, some challenges, and that's time where is the right time for investor to invest, because you are entering at a reasonable valuation. So a margin of safety is in your favor. That's number one. Number two, if you look at it from the global perspective and even India perspective, the worst of inflation is behind you. Worst of supply chain pressure index is behind you. The worst of interest rate hike is behind you. Everybody was waiting for budget. Even that event is gone with a positive news, no negative and many positives, small but impactful positives. So I think we are entering in now in a overall good growth, earning growth zone perspective. I think after probably another 1 quarter, some effect of global slowdown will be there. But after that, again, you will start having the good growth. So I think India's story looks reasonably solid. Coming to your important question on, you know, values have done well or growth has done well. I think ultimately, you know, value also performs only when the growth comes to it. So for example, a Tata Steel stock will go up only when you become bullish on steel prices. I mean, if you are bearish on steel prices, Tata Steel stock cannot move up. Am I right? So ultimately, if there is a growth, then those stocks will deliver reasonably well. Whether there is even PSU banks, for example, they did well last year because the earnings were keen. Look at the net interest income growth. Look at the pre-provision profit growth. Look at the provision reduction and therefore significantly higher earnings growth. The credit cost is reduced significantly. And that's why market is always efficient. You need to be a little bit ahead of time. You cannot be just in time every time. That's a wishful thinking. You need to take some pain before, you know, the cycle comes in your favor. you need to be a little bit ahead, and that's when the stocks start delivering the results. So any value stock which has performed in 2022, if you look at the actual numbers, what they are now delivering and has delivered in last 6 months, the earnings growth came in their favor. And that's why those value stocks went up. There is not a single value stock, 90% of them, that if earnings growth is missed and the stock delivers. I don't think so. That's never the case. So whether it is a value of growth, first important, buy earnings growth, and then you buy at a reasonable valuation. That's the mantra to make long-term money. And remember one thing, you need to be agile. So if software stocks, if you're holding in the month of March, you might be holding the number one company of the country, but that stock is down 40%. Exactly 2 years back, everybody was bullish. Till February, everybody was bullish. And in March, if you are bought, by now we are down 40%. Nothing wrong in the company. But what went down is the expectations of the earnings growth. And that's the art and science of fund management. That what you need to be very clear is that you need to be agile. You need to make sure what you are. Look at auto sector. It was a negative profit contribution in 2021 and 2022. And the contribution from zero is now going to become 30% to Nifty. And commodities, which contributed almost 30% in FY22, in FY23, that is becoming zero. So the business cycles keep changing. World is moving very fast. The business needs to be agile, and it demands agility even from the fund manager perspective. I keep saying, everybody knows what to buy. Please tell me when to sell. And that's basically what the discipline exit strategy makes the ultimate returns for the long-term investors.
Makes sense. So it's the expectations of earnings growth, which is triggered by quarterly numbers typically, is what starts a trend in even the value stocks. So thank you. It's time up. Thank you, Andrew. Thank you, Rajesh. Thank you, Jyoti, for such an insightful session. Thank you, everyone, for joining us. I'll give it back to Akruti. Thank you.
Thank you.
Thank you, PMS AIF.
Bye.